In this video, I'm going to talk you through cash flow planning for your business. I will explain why you need to consider it, show you exactly how to set up your own cash flow plan, and provide you with a template to make it nice and simple for your business. If you haven't subscribed yet, make sure you hit the subscribe button and turn on the bell so that you know next time I upload a video about all things business money. I am Annette Ferguson, Chartered Accountant, Certified Profit First Professional and CEO of Annette Co, a UK-based accounting firm. Cash flow forecasting enables you to predict peaks and troughs in your cash balances in your business. It tells you how much surplus cash you might have at any point in time, and also warns you if there's going to be a cash deficit position and if you need to course correct what's happening in your business, or perhaps indeed consider short-term borrowing requirements. Many banks also require forecasts to be done before considering loans or overdrafts. The overall forecast is usually done for a year or a number of months, and sometimes can also be divided up into weeks or even days, which can be incredibly useful if cash is very tight within a business. One key part of cash flow planning is the revenue plan, and it's really important to be realistic in your revenue plans. We can all get excited as business owners as to what our revenues might do, but when we are cash flow forecasting, we do need to make sure that we have a heavy dose of realism in the cash flow forecast so that we can predict the most accurate likely scenario. So the basic premise of your cash flow forecast is that you list all your cash incomings and your cash outgoings in the applicable month or week that you expect them to happen. Remember, of course, that when you say invoice a customer, it is not necessarily when the cash comes in the door. So you might need to look at some other pieces of data in your business. For example, what is the typical length of time between an invoice being issued and cash being received in your business so that you can accurately predict when cash comes in, and also look at the associated costs with delivery of your product or service and when payments typically go out. There are also some things that can affect your cash flow forecast that might end up being unforeseen issues, and they impact the cash in your business nonetheless. Things like loss of a major client or customer, or perhaps even insolvency of a client that owes you money. Things like changes in interest rates can also affect the business, particularly if it is heavily leveraged with debt, as can things like inflation, which can end up pushing up the prices that your suppliers charge you. Which goes to show that cash flow forecasting is not an exact science, but with practice, we tend to get closer and closer to the reality, and it becomes a more and more important tool and useful tool for your business. So where do we even begin when we speak about forecasting our future cash flow? Well, the main thing that people usually start with is the history of the business. What happened last year? This is called incremental budgeting, where you look at the previous financial performance of the business and you use that as a starting point for the future. What has historic revenue growth been, for example? And what have the costs associated with that been? Both the costs associated with servicing the clients and also things like your fixed costs and your staff costs. Looking at the historics can give us a good indication of what the future might look like. And so, for most businesses, that is the basic starting point. It's an easy place to begin because for most businesses, the information is readily available and there's little additional quantitative analysis that's needed on the data other than that you will have already looked at within your business. But one big problem with using history to predict the future is that you can end up locking in inefficiencies that exist in your business. You can end up locking in wasteful spending, for example. So Although you want to look at the previous year's performance to start building out your cash flow forecast for the future, you do also want to layer in that dose of, is this what we want for the future, as well when you're making those decisions as to which costs you're going to carry forward. Also, if you're in a business that's rapidly changing or you're choosing to pivot your business significantly, then looking at the historics is probably not going to be a highly accurate way for you to predict the future either. And in these situations, it might be better to use a system called zero-based budgeting. This is basically where you start with a blank piece of paper and you say, okay, if today was day 0, what would my business look like tomorrow and next month and next month and next month? This can get rid of inefficiencies. It can also get rid of those emotional tie-ups that you might have with certain types of spending or even certain team members in your business. This also helps to foster a questioning attitude towards all activities that are done in your business, both the sales and the cost side. Are these things working for me and my business? And are these things I want to continue with? Can be a really important question to ask yourself as you move forward. Also, when planning your cash flow forecasting, I don't like to look at this as a document that's done once a year and then just sits on a virtual shelf collecting digital dust. For me, a cash flow forecast is a constantly moving document. It's one that's reviewed on a monthly basis and new months are added to the end each time. It is tweaked and changed and morphed as the business progresses over the months and years. And this type of budget is called a rolling budget. This type of forecasting helps you keep a much closer eye on costs and a much tighter rein on what's happening financially within your business, which is incredibly important, particularly for small businesses. If you're getting value on this video so far, do make sure you hit that like button. So how do we do this cash flow forecast in practice? Well, I'm going to share my screen with you and let you see. So here I have a basic cash flow plan, which is set up monthly. Now, for most businesses, monthly cash flow planning will be enough. But like I mentioned before, if you are in a period of incredibly tight cash, it might be worthwhile then breaking this down into weekly or even daily cash flow planning. How I like to split up this is having the income section at the top, then your cost of sales, which you may or may not have depending on the type of business that you run. I then have a gross profit summary here. I like to separate out teams separately. It helps me just assess how much of my revenue is being spent on team. I then come down to this expenditure section, which is the general costs of the business. This will also, by the way, include capital spend. Remember, this is a cash flow planning template. So we are not thinking in terms of how things are classified for tax purposes here. We're thinking about the actual spend that goes out the business, the actual cash that is leaving the business. So in this expenditure section, we're going to have the general operating expenses of the business. We're also going to have capital spend in here, and debt repayments that are being made are all going to be in this general expenditure section. There is then a tax and VAT section. Now, I put these in here on a monthly basis because I believe that you should be moving that cash out into a separate savings account. You should be ring fencing that cash away from your general business spending. And so I have those coming out monthly, and I have them based off a set percentage to give us a good estimate of how much those would be. We then come down, and at the bottom here, we also have a line for your take home, the money that you're going to be taking out the business. And then we have a cash inflow outflow total. So what is the balance? Is the overall balance positive, i.e. we are growing in our cash balances in our business, or is the overall balance negative, meaning we are depleting cash balances in our business? You can also add in here an opening cash balance for the bank account balance at the beginning of each month if you wish, so that you can see that a little bit more clearly as to whether you will have enough cash actually physically in the bank account as well. So often the easiest place is to begin with the income. And what I recommend is that you split out the income into your different revenue streams. So you're going to have revenue stream 1, revenue stream 2, revenue stream 3, and then you're going to have in here how much you expect from each revenue stream. Some stuff you may expect cash to come in monthly if you have people on regular payments or payment plans, and other things you might expect to be launching and you don't give people payment plans, so they only have one bulk option to pay. So bear that in mind. Remember, this is a cash basis. So this is not on when you invoice people. If you do a launch, for example, and everyone pays on a payment plan, you're going to have to spread that across the months that they make the payments. Even if you have a 100K launch, if your payments then come in over the next 12 months, you don't put 100K in that launch month. You spread it across the months of when the payments come in. Now in this template, I have automatically set up a calculation for card processing and PayPal fees based off the income of the business. Now, if your business does not process payments in that way, you don't need this line, but many businesses do now with online sales. The other things you might need to consider in cost of sales entirely depends on the type of business that you have. If you're a product-based business, you're going to have your purchases, your materials in here, perhaps packaging costs or postage within that cost of sales. If you run an online business, you may not have any other cost of sales other than this. So this will be entirely dependent on the type of business you have. But again, remember, this is based on cash. So if you're a product business and you are having to purchase product ahead of time and you have to pay out a whack to get your product delivered into your warehouse or into, say, Amazon warehouses, then you're going to have to put that amount as a oneer when you make the payment or when you're due to make the payment into your cash flow planning template. This is all about when cash moves. So remember that when you're entering your cost of sales amounts. Next, we come to the team section of our plan. And you can see in here that I have split out net salaries, PAYE and NI, and pension. And that is because the timing of these things matters. So it may be that you pay salaries at the end of the month, but the national insurance, PAYE, and pension contributions associated with, say, January salary payments won't go out your bank account until February. So again, you need to make sure that the right numbers are in the right months, because this is cash flow planning. This is about putting the numbers in the correct months in the sheet. So you want to put in your net salaries in the salaries line, because the other parts are going in the other places when the correct month and when the correct date hits. So you can fill in that team section, and then we come down to expenditure. Now, some people like to list this out as headings. So say software costs, advertising and marketing. I personally believe that it's better to list out these expenses as granular as you possibly can. Therefore, putting in the supplier name. So let's put in Zoom rather than software expenses, or let's put in AXA insurance rather than business insurance, so that we can get really clear on all the spending that you have, exactly where it's going and exactly when it happens. Remember to factor in one-off annual payments, like payments to the ICO that you might have to make, which is one that people often forget to add in. So like I mentioned before, in this expenditure section, this is all other costs, excluding taxes and money to yourself. So anything else that you plan to spend needs to go into this expenditure section. And then we come down to the tax and VAT section. As it stands, I have formulas in this spreadsheet to calculate roughly what those amounts are, but you don't have to rely on the formulas if you wish to change that up and calculate it differently yourself, you absolutely can. If you wish to change the VAT so it actually appears quarterly in alignment with your actual VAT payments, you can do that. Like I mentioned, I like to put VAT and tax in monthly here because I recommend that you strip these amounts out of your current account and put them into a separate bank account. So this is cash that does not become available generally in your business so that you have it set aside when you need to make those payments. Personally, I believe that is the best way to do it so that you are not going to find yourself short when it comes to tax and VAT payment time, but that you don't have to do that if you don't wish to. You can change it so that you have the tax payment just being shown on your tax payment date and the VAT payments being shown on your VAT payment date. And then, of course, we have your own take home. We don't run a business so that we can't take money home. So we need to make sure that our own take home as a business owner is included in our cash flow plan. So do make sure you put that amount in there. Regardless of whether you pay yourself through salary or dividends, get that take home, the total amount that you are going to be taking home from your business, that you are going to be taking out your business bank account and paying to yourself, needs to go in that take home line. And then this bottom line, cash inflows and outflows, that is a calculation of all the ins minus all the outs. And what is the balance? Ideally, we need the balance to be positive there. We want to be running a cash positive business. And if it's not, then we need to assess the situation, because that means that either we are going to be using surplus from prior months, or we might have an issue in terms of going into our overdraft or something like that. So we need to assess any negative periods that you might have when you look at the cash inflows minus the cash outflows. Now, you might also need to consider, if you are running a seasonal business, making sure that you align your cash flow revenue plan and costs with the seasonality of the business. You can look at historics to get a pattern of seasonality in your business and to be able to forecast it that way. And if you want a copy of this template that I have just reviewed, then the link is in the description to this video so that you can get a blank copy of the template. You can copy that and you can complete it for your business. I also dig deep into forecasting in my book, The Profit Plan, which is currently available in Kindle and soon to be in paperback as well. And I again will include a link to that in the description to the video too. I hope that explains the need for cash flow planning and gives you a basic outline as to how you can start cash flow planning in your business. If you're struggling with the accounting in your business, I would love to help. Do reach out to me at yt@annetteco.co.uk and let me know how I can support you. Thank you so much for watching. Hit the like button, subscribe, and I'll see you in the next video.